I can't afford to invest. Sound familiar? Well, what if I told you that $1,000 could kickstart your wealth-building journey? It's true, and I'm going to show you exactly how. In this video, we're breaking down the power of that first $1,000 investment. You'll learn why it's more than enough to get started, and how it can grow into something life-changing. Ready to see your money work for you? The power of $1,000, more than you think. Let's talk about something that might surprise you. The power of $1,000. I know what you're thinking. $1,000? That's not exactly a life-changing amount, right? Well, hold on to your seats, because we're about to challenge that idea. Many of us have this notion that we need a big chunk of change to start investing. We see those fancy finance shows talking about millions and billions, and it's easy to feel like our modest savings don't stand a chance. But here's the thing, that $1,000 you've been saving, it's got way more potential than you might realize. Think about it for a second. What's the last big purchase you made with $1,000? Maybe it was a new phone or that weekend getaway you'd been planning. Now, I'm not saying those things aren't important. We all need a little fun in our lives. But what if I told you that same $1,000 could be your ticket to some serious financial growth? Let's break it down with some numbers. If you took that $1,000 and invested it wisely, earning an average return of 8% per year, which is pretty realistic for long-term stock market returns, do you know how much it could grow to in 30 years? Over $10,000. That's right, your money could multiply 10 times without you adding another cent. Now, I can see you raising an eyebrow. Sure, you might be thinking, but 30 years is a long time, and $10,000 isn't exactly retirement money. Fair point. But here's where it gets really exciting. What if you didn't stop at that initial $1,000? What if you added just $100 a month to your investment? With that same 8% return, your investment could grow to over $150,000 in 30 years. Now we're talking, right? That's a down payment on a house, or a big chunk of your kid's college tuition, or maybe even the start of your early retirement fund. I know these numbers might seem a bit abstract, so let's put them in perspective. Remember that new phone we talked about earlier? In a year or two, it'll probably be outdated, and you'll be eyeing the next shiny model. But that $1,000 you invested? It's just getting started on its journey to multiply into something much, much bigger. Now, I'm not saying you should never buy a new phone or treat yourself. Life is about balance, after all. But it's worth thinking about how we can make our money work harder for us. That $1,000 isn't just enough to start investing. It's a powerful seed for your financial future. But maybe you're still not convinced. Maybe you're thinking, okay, but I don't know the first thing about investing. Isn't it risky? What if I lose all my money? These are totally valid concerns, and it's good that you're thinking critically about your finances. Here's the thing, though. Investing doesn't have to be complicated or super risky. There are plenty of ways to get started that don't require you to become a Wall Street expert overnight. For example, you could look into low-cost index funds, which basically let you buy a tiny piece of hundreds of different companies all at once. This spreads out your risk and makes it less likely that you'll lose everything if one company has a bad year. Or maybe you've heard about robo-advisors. These are online platforms that use computer algorithms to manage your investments for you. You just answer some questions about your goals and risk tolerance, and they do the rest. It's like having a financial advisor in your pocket, often for a fraction of the cost. The key here is to start small and learn as you go. You don't have to become an investment guru overnight. In fact, some of the most successful investors are the ones who keep things simple and consistent. Now, let's address another concern you might have. But what if I need that $1,000 for an emergency? This is a smart question to ask. It's always important to have some money set aside for unexpected expenses. But here's a little secret. Investing and saving for emergencies don't have to be mutually exclusive. In fact, many investment accounts let you withdraw your money if you really need it. Sure, you might face a small penalty if you take it out too soon, but it's not like your money is locked away forever. And as your investment grows, you might find that you have even more of a cushion for those just-in-case moments. The bottom line is this. Your $1,000 isn't just enough to start investing. It's a powerful seed for your financial future. It's the first step on a journey that could lead to financial freedom, security, and the ability to achieve your biggest dreams. Understanding strategic investing. Your money's game plan. let's talk about something that might surprise you. Strategic investing isn't about finding the next big thing or picking hot stocks. I know. That's what we often see in movies or hear from that one friend who's always talking about their latest investment tip. But here's the thing. Real investing, the kind that builds wealth over time, is more like planning a road trip than playing the lottery. Think about it. When you're planning a road trip, you don't just jump in the car and start driving, right? You figure out where you want to go, how long you have to get there, and what kind of vehicle you need. Investing works the same way. It's all about having a clear destination in mind and choosing the right way to get there. So, let's start with the destination. What are your financial goals? This isn't just about making more money. That's way too vague. Are you saving up for a down payment on a house? Building an emergency fund? Planning for retirement? Or maybe you're dreaming of that once-in-a-lifetime vacation. Whatever it is, getting clear on your goals is the first step in strategic investing. Brian Ford, head of financial wellness at Truist, puts it perfectly. All investments should have a purpose. A goal of making more money is not investing. Everyone wants to make more money. Are you saving for a house? Creating an emergency fund? Saving for retirement? Then you can start to talk about your time horizon. Once you know where you're going, it's time to choose your vehicle. In the investing world, these vehicles are different types of investments. Some are like sports cars, fast and exciting, but also risky. That's kind of like individual stocks. Others are more like buses. They might not be as flashy, but they're reliable and can carry a lot of people, or in this case, your money safely. That's more like index funds. Speaking of index funds, let's talk about why they're often recommended for beginners. It's because they offer built-in diversification. Remember how I mentioned packing for different types of weather on a road trip? That's what diversification does for your investments. It spreads your money across lots of different assets, so if one area isn't doing well, you're not losing everything. The Truist article explains it well. Diversification means spreading your money across different assets to mitigate risk. You could diversify by investing in mutual funds or by owning a mix of individual stocks, bonds, or other types of assets. Now you might be wondering, but what if I want to pick my own stocks? I get it. It can be tempting to try and find the next big thing. But here's something to keep in mind. About 90% of people lose money when trying to pick individual stocks. That's a pretty risky game to play, especially when you're just starting out. Instead, consider this advice from Warren Buffett, one of the most successful investors of all time. He says, "In my view, for most people, the best thing to do is own the S&P 500 index fund. The trick is not to pick the right company. The trick is to essentially buy all the big companies through the S&P 500 and to do it consistently and to do it in a very, very low-cost way." Why does Buffett recommend this? Well, the S&P 500 index fund has historically provided an average annual return of about 10%. In fact, over the last 10 years, it's averaged 13.6%. That's pretty impressive, especially when you consider how hands-off this approach is. But what if the market goes up and down? That's where another smart strategy comes in: dollar cost averaging. This is just a fancy term for investing a fixed amount regularly, regardless of what the market is doing. It's like setting your car on cruise control. You keep moving forward at a steady pace, no matter if you're going uphill or downhill. The Truist article explains why this is so effective. Dollar cost averaging can take away the guesswork of trying to time the market, which the vast majority of investors can't do, and help your investments weather the ups and downs of the market. Now, let's talk about something that often gets overlooked when we discuss investing: investing in yourself. This might not seem like traditional investing, but it can actually yield higher returns than many other investments. Think about it. If you invest in your education or skills, you're increasing your earning potential. That's a return that keeps on giving. As one source puts it, investing in your own education is generally a very reasonable thing to do. The return on this £100 is way higher than just 7% because you fundamentally increased your own value to the market. So, what does all this mean for your $1,000? It means you have options. You could start by opening an account with a low-cost index fund. Or you might choose a robo-advisor that uses computer algorithms to manage a diversified portfolio for you based on your goals. And risk tolerance. You could even split your investment, putting some into an index fund and some into personal development, like an online course that could boost your career. The magic of compound interest, your money's best friend. Let's talk about something that might just blow your mind, compound interest. You've probably heard the term before, but have you ever really thought about how it could transform your financial future? It's not just a fancy financial concept. It's like having a secret weapon in your money arsenal. Here's the thing. Compound interest isn't just about your money growing. It's about your money making more money, which then makes even more money. It's like your cash is working overtime for you, even while you're sleeping. Now, you might be wondering, okay, but how does this actually work? Let's break it down. When you invest your money, it earns returns. But here's where the magic happens. Those returns start earning returns too. It's like a snowball effect, but instead of snow, we're talking cold, hard cash. Think about it this way. Imagine you're planting a money tree. I know, but stick with me here. At first, it's just a little sapling. But as time goes on, it grows bigger and starts producing more seeds. Those seeds then grow into more trees, which produce even more seeds. Before you know it, you've got a whole forest of money trees. That's basically what compound interest does for your investments. It takes your initial amount and helps it grow exponentially over time. And the best part? The longer you let it grow, the more powerful it becomes. Now, I've got a fun fact for you. Did you know that Albert Einstein, that Einstein, called compound interest the eighth wonder of the world? He even said, "He who understands it earns it. He who doesn't pays it." Pretty strong words from one of the smartest people in history, right? But here's the catch. Compound interest needs two things to really work its magic: time and consistency. The earlier you start investing, the more time your money has to grow. And if you can add to your investments regularly, even in small amounts, you're giving that compound interest even more to work with. Let's say you decide to invest in yourself by taking an online course to boost your career skills. That's another form of compound interest. The knowledge and skills you gain don't just sit there. They grow and compound over time, potentially leading to better job opportunities, higher pay, and even more chances to invest in your future. Now, I know what you might be thinking. This all sounds great, but I'm not sure I have enough to make a real difference. But here's the truth. Even small amounts can grow into something significant over time. That $1,000 you're thinking of investing? It's not just $1,000. It's the seed that could grow into your financial forest. Remember, compound interest is like having a money-making machine that works harder the longer you let it run. It's patient, it's persistent, and it doesn't take coffee breaks. All it needs is for you to get started and give it time to do its thing. So, are you ready to put your $1,000 to work in this magical money multiplier? Are you excited to see how it could grow over time? Because let me tell you, understanding and using compound interest could be the game changer in your financial journey. In the next section, we're going to dive into exactly how you can start harnessing the power of compound interest. We'll look at different investment options and how to choose the right one for you. Because now that you know about this financial superpower, it's time to put it into action. Index funds, your $1,000 ticket to the whole market. Let's talk about a game changer in the investing world that's perfect for beginners like you. Remember how we mentioned that investing your $1,000 could give you a slice of the entire market pie? Well, that's exactly what index funds do, and they're about to become your new best friend in the investing world. Think about it. When you're just starting out, the idea of picking individual stocks can feel overwhelming. It's like trying to predict which horse will win a race when you've never even been to a racetrack. But what if I told you there's a way to bet on all the horses at once? That's essentially what index funds let you do with the stock market. Here's the thing. An index fund is like a basket that holds a little piece of hundreds or even thousands of different companies. When you buy into an index fund, you're not just investing in one company. You're investing in a whole bunch of them at once. It's like going to a buffet instead of ordering a single dish. You get a taste of everything. Now, you might be wondering, why would I want to invest in so many companies at once? Great question. The answer is simple: diversification. By spreading your money across many different companies, you're not putting all your eggs in one basket. If one company has a bad year, it won't sink your entire investment because you've got plenty of others to pick up the slack. But here's where it gets really exciting. Index funds aren't just about playing it safe. They can also be incredibly powerful wealth builders. Studies have shown that most actively managed funds, where professionals try to pick winning stocks, actually underperform compared to index funds over the long term. In fact, it's been reported that a whopping 92% of top hedge funds have trailed behind the S&P 500 index over a 15-year period. That's like saying that even the pros have a hard time beating the market. So, what does this mean for you and your $1,000? It means you can invest like a pro without needing a finance degree or a crystal ball. By choosing an index fund, you're essentially saying, I believe that over time, the economy as a whole will grow. And historically, that's been a pretty safe bet. Let's get specific. If you're looking to dip your toes into index fund investing, there are some popular options that are perfect for beginners with $1,000 to invest. Two examples are the Vanguard S&P 500 ETF, VO, and the SPDR S&P 500 ETF, SPY. Both of these funds give you exposure to the top 500 companies in the US stock market. That means with just one purchase, you could own a little piece of giants like Apple, Amazon, and Google, as well as hundreds of other successful companies. But the benefits of index funds don't stop there. They're also incredibly cost-effective. Because they're not actively managed, remember, they're just following an index. They have much lower fees than many other types of investments. This means more of your money stays in your pocket and has the chance to grow over time. And speaking of time, index funds are perfect for long-term investing. They allow you to ride out the ups and downs of the market without constantly worrying about which stocks to buy or sell. This set-it-and-forget-it approach can be a huge stress reliever, especially for new investors. Now, you might be thinking, this all sounds great, but what about when the economy isn't doing so well? That's another area where index funds shine. During economic downturns, having your money spread across many different companies can actually help protect you from major losses. Instead of relying on the performance of just one or two stocks, you're cushioned by the collective performance of hundreds of companies. Let's talk about how this plays out in real life. Imagine you invested your $1,000 in an S&P 500 index fund. You'd instantly become a partial owner of 500 of the largest companies in America. When you watch the news and hear about how well, or not so well, the stock market is doing, you'll know that your investment is moving right along with it. Over time, as the economy grows and these companies become more valuable, so does your investment. The best part, getting started with index funds is surprisingly simple. Many online brokers offer these funds with low or no minimum investment requirements, making them perfect for your $1,000 starting point. You don't need to spend hours researching individual stocks or trying to time the market. Instead, you can focus on consistently adding to your ETFs. Flexibility meets affordability. Let's talk about a financial tool that might just be the perfect fit for your $1,000 investment, exchange-traded funds, or ETFs for short. Think of ETFs as the cool cousin of index funds, offering a similar way to diversify your investments, but with an extra dash of flexibility. Here's the thing. ETFs allow you to buy a bundle of stocks or bonds that can be traded just like individual stocks. It's like getting a pre-packaged investing solution that you can buy and sell whenever you want. Pretty neat, right? Now you might be wondering, what makes ETFs so special? Well, let me break it down for you. First off, ETFs give you more control over your investments. Unlike mutual funds that only trade once a day after the market closes, you can buy and sell ETFs throughout the trading day. This means you can react to market changes more quickly if you want to. But wait, there's more. ETFs often come with lower fees compared to mutual funds. We're talking about expense ratios that can be as low as 0.2% on average. That might not sound like much, but over time, it means more of your hard-earned money stays invested and working for you. Here's where it gets really exciting for beginners like you. Many ETFs have no minimum investment requirement. You can start investing with as little as the price of one share. This is perfect when you're starting with $1,000 because it means you can spread your investment across different types of ETFs. Let's paint a picture of what this could look like. With your $1,000, you could buy shares in a US stock ETF, an international stock ETF, and maybe even throw in a bond ETF for good measure. Just like that, you've created a diversified portfolio that spans different markets and asset types. It's like being a global investor right from the comfort of your own home. Now, I know what you're thinking. This sounds almost too good to be true. What's the catch? Well, it's important to remember that while ETFs offer diversification, they still carry risks. If the overall market takes a nosedive, your ETF values will likely follow suit. That's just part of the investing game, and it's why we always stress the importance of thinking long-term. But here's why experts often recommend ETFs for new investors like you. They simplify the investment process. Instead of spending hours researching individual stocks and trying to pick winners, which, let's face it, even the pros struggle with, you can invest in a broad market with just one transaction. It's like having a professional chef prepare a gourmet meal for you instead of trying to cook everything from scratch yourself. One thing to keep in mind is that while ETFs are great for many situations, they might not always be the best choice. For example, in really volatile markets, actively managed funds might perform better because fund managers can make quick decisions to try and minimize losses. But for most beginners looking for a simple, low-cost way to start investing, ETFs are hard to beat. Remember, though, that no investment is without risk. ETFs don't guarantee profits or protect you from losses. It's super important to do your homework before investing. Look at things like the ETF's track record, what it actually holds, and how it fits into your overall financial goals. The beauty of ETFs is that they offer a flexible, low-cost way to build a diversified portfolio, even when you're starting with just $1,000. You get the benefits of professional management and broad market exposure without needing a fortune to get started. It's like having your cake and eating it too. Dividend stocks, making your money work over time. Let's talk about a way to make your money work over time. Dividend stocks. Imagine if your investments could pay you while you sleep. Sounds pretty great, right? Well, that's exactly what dividend stocks can do. Most people think of stocks as something you buy low and sell high. But there's a special kind of stock that can give you regular income without selling a single share. Welcome to the world of dividend stocks. These are shares in companies that pay out a portion of their profits to shareholders, like you. Think of it this way. When you own dividend stocks, it's like owning a tiny piece of a business and getting a share of the profits. Let's break it down with a simple example. If you own $1,000 worth of a stock with a 3% dividend yield, you'd get about $30 a year in dividends. Now, $30 might not sound like much at first, but here's the thing. You still own the stock, which could also increase in value over time. But wait, it gets even better. What if you took those dividends and used them to buy more shares of the same stock? This is called reinvesting your dividends, and it's a smart money move that can really boost your investment growth. By reinvesting, you're increasing your ownership in the company, which means more dividends in the future. It's like a snowball effect for your money. Now, you might be wondering if dividend stocks are really worth it. Well, here's an interesting fact. A study showed that dividend-paying stocks have actually outperformed non-dividend-paying stocks over the long term. Why? Because companies that pay dividends tend to be more established and financially sound. They're often the steady eddies of the stock market. If you're new to investing, dividend stocks can be a great place to start. They offer a combination of income and potential capital appreciation, which is just a fancy way of saying the stock price might go up too. This dual benefit can help cushion the blow when the market gets a bit bumpy. So, what kind of companies pay dividends? Think big, established names. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have a history of consistently paying and even growing their dividends over time. These are the kinds of companies that have been around for decades and are likely to stick around for many more. Now, let's talk numbers for a second. The average dividend yield in the market is around 1.3%, but many established companies offer higher yields. For example, Coca-Cola's dividend yield is about 2.86%. That's like getting a little bonus just for owning a piece of the company. But here's a pro tip. Don't just chase the highest dividend yield you can find. It's important to look at something called the payout ratio. This tells you how much of a company's earnings are being paid out as dividends. If it's too high, it might mean the company is returning most of its earnings to shareholders, which could be risky if the company hits a rough patch. If picking individual stocks sounds a bit overwhelming, don't worry. There's an easier way to get started with dividend investing. Enter dividend ETFs. These are like baskets of dividend-paying stocks, all wrapped up in one easy-to-buy package. For example, the SPDR Portfolio S&P 500 High Dividend ETF, SPYD, gives you exposure to a whole bunch of dividend-paying stocks in one go. It's like instant diversification for your dividend portfolio. One more thing to keep in mind. Dividend stocks are often seen as a safer bet during economic downturns. They tend to hold their value better than growth stocks, which can be a comfort when the market starts to look like a roller coaster. This stability can be particularly appealing if you're just starting out and feeling a bit nervous about market ups and downs. Remember, investing in dividend stocks isn't just about the immediate income. It's about building a foundation for long-term wealth. Those quarterly dividend payments can add up over time, especially if you reinvest them. And as you continue to invest and grow your portfolio, your dividend income could potentially grow too. Opening your first investment account. Easier than you think. Now, let's talk about a step that often feels like a big hurdle for new investors. Opening your first investment account. You might be thinking, ugh, paperwork and complicated forms. But what if I told you that setting up your investment account is about as easy as creating a profile on your favorite social media platform? Let's break down this process and show you just how approachable it really is. Many people put off investing because they assume opening an account is a hassle. They picture themselves drowning in paperwork or spending hours on the phone with customer service. But here's the thing. In today's digital age, you can open an investment account in just a few minutes, right from your phone or computer. It's like ordering takeout, but instead of food, you're ordering financial freedom. So, where do you start? First, you'll need to choose a brokerage. Think of a brokerage as the platform where you'll do all your investing. When you're picking one, look for low fees and no minimum balance requirements. This way, you can start investing with your $1,000 without worrying about extra costs eating into your investment. Some popular options for beginners include Fidelity, Charles Schwab, and Vanguard. These brokerages are known for their user-friendly interfaces and robust customer support. Fidelity, for example, offers a wide range of investment options with no minimum balance requirement for most accounts. Charles Schwab provides commission-free trading and has a user-friendly mobile app, which is great if you want to manage your investments on the go. Vanguard is highly regarded for its low-cost index funds and ETFs, which are excellent options for new investors wanting to diversify their portfolios without high fees. Once you've chosen your brokerage, it's time to set up your account. This part is straightforward. You'll need to provide some basic information. We're talking about things like your name, address, social security number, and employment details. It's similar to the info you'd give when applying for a new credit card or opening a bank account. Most brokerages will also ask about your investment goals and risk tolerance. This isn't a test. There are no right or wrong answers here. Be honest about your financial goals and how comfortable you are with risk. Are you saving for a house down payment in 5 years? Or are you thinking long-term about retirement? Do market ups and downs make you nervous? Or are you okay with some fluctuations? Your answers help the brokerage guide you towards investments that match your needs and comfort level. Now, here's a cool feature that many people don't realize. Some brokerages let you practice investing with virtual money before you commit your real cash. For instance, Trading 212 offers this option. It's like a flight simulator for investing, helping you gain confidence before you take off with your actual $1,000. Once your account is set up, you'll need to link your bank account and transfer your $1,000. This process is usually as simple as transferring money between your checking and savings accounts. Many brokerages, including Fidelity and Charles Schwab, allow users to start investing with as little as $1, so your $1,000 is more than enough to get started. Remember, when you're choosing a brokerage, it's not just about the fees and minimum balances. Think about the whole package. Does the brokerage offer educational resources to help you learn more about investing? How's their customer service? Can you easily reach someone if you have questions? User reviews often highlight the importance of these features, especially for beginners. The user interface of the brokerage's website or app is also crucial. You want something that's easy to navigate and understand. Platforms like Fidelity and Vanguard are often praised for their intuitive designs that simplify the investment process. After all, you want to spend your time making smart investment decisions, not trying to figure out how to use the platform. Dollar cost averaging, your secret weapon against market ups and downs. So you've got your account set up and you're ready to invest. But here's a question that might surprise you. What if investing all your money at once isn't actually the best move? There's a strategy that even seasoned investors swear by, and it could be your secret weapon for long-term success. It's called dollar cost averaging, and it's simpler than you might think. Let's talk about why this matters. Picture this. You've saved up $1,000 and you're excited to start investing. But then you start to worry. What if the market crashes right after you put in your money? Or what if you invest and then the market suddenly skyrockets and you miss out on bigger gains? It's enough to make anyone hesitate. Here's the thing. Even professional investors can't predict exactly what the market will do. So instead of trying to time it perfectly, dollar cost averaging offers a different approach. The idea is to invest a fixed amount of money at regular intervals, regardless of what the market is doing. Think about it like this. Instead of throwing all $1,000 into the market at once, you might decide to invest $250 every month for 4 months. This way, you're spreading out your investment over time. And here's where it gets interesting. When the market is down and prices are low, your $250 will buy more shares. When the market is up and prices are high, that same $250 will buy fewer shares. But why is this a good thing? Well, over time, this strategy can help lower the average price you pay per share. It's like shopping for your favorite clothes. Sometimes you buy them at full price, sometimes on sale. In the end, you've got a closet full of great outfits at a better average price than if you bought everything all at once. Now, you might be wondering, does this really make a difference? The answer is yes, especially during market downturns. Let's look at a real-world example. During the 2008 financial crisis, investors who used dollar cost averaging came out ahead compared to those who invested a lump sum. Why? Because they were able to buy more shares when prices were low, which led to bigger gains when the market recovered. But the benefits of dollar cost averaging go beyond just potential financial gains. It can also help reduce the emotional stress of investing. Think about how you'd feel if you invested all your money at once and then the market dropped. Pretty stressful, right? With dollar cost averaging, you don't have to worry as much about timing the market perfectly. You're investing consistently through ups and downs, which can help you feel more in control. Financial experts often recommend this strategy, especially for new investors. It allows you to build your investment portfolio gradually, which can be really helpful if you're unsure about market conditions or your own risk tolerance. It's like dipping your toes in the water before diving in. You get to experience investing without the pressure of going all in at once. Now, let's be real for a moment. Dollar cost averaging isn't a guarantee that you'll always come out ahead. If the market trends upward consistently after your initial investment, you might have made more money by investing a lump sum. But here's the important part. For most of us, especially when we're just starting out, the benefits of reduced anxiety and risk often outweigh the potential for slightly higher returns. Think about it this way. Investing isn't just about the numbers. It's also about developing good habits and feeling comfortable with your financial decisions. Dollar cost averaging can help you do both. You're not just investing your money, you're investing in your financial education and confidence. So, how can you put this strategy into action? It's pretty straightforward. First, decide how much you want to invest overall. Then, choose how often you want to invest, weekly, monthly, or quarterly, for example. Set up automatic transfers from your bank account to your investment account on those dates. This way, you're sticking to your plan without having to think about it too much. Remember, the key to making dollar cost averaging work is consistency. It's not about trying to outsmart the market or making big, dramatic moves. It's about steady, consistent investing over time. Think of it like watering a plant. A little bit of water every day is often better than dumping a whole bucket on it once a month. Diversification. Don't put all your eggs in one basket. Let's talk about a smart money move that could really make a difference in your investing journey. You know how they say you shouldn't put all your eggs in one basket? Well, that's exactly what we're going to explore when it comes to your $1,000 investment. Think about your favorite restaurant for a moment. Would you always order the same dish every time you go there? Probably not, right? You'd want to try different things on the menu to get a variety of flavors and experiences. Well, investing works in a similar way. This strategy of spreading your money around is called diversification, and it's a game changer for your financial future. Here's the thing. When you're just starting out, it's tempting to put all your money into that one hot stock everyone's talking about. Maybe it's a tech company that's been all over the news, or a trendy startup that your friend swears is the next big thing. But that's like betting your entire savings on a single number at the roulette table. Sure, you might win big, but you could also lose it all. Diversification is like ordering a sampler platter instead of just one dish. You get to taste a little bit of everything, and if one item isn't to your liking, you've still got others to enjoy. In the investing world, this means spreading your $1,000 across different types of investments. So, how does this work in practice? Well, instead of buying shares in just one company, you could split your $1,000 between a few different investments. For example, you might put some money into a fund that tracks the overall US stock market, some into international stocks, and some into bonds. This way, you're not putting all your faith in just one part of the market. The beauty of diversification is that it can help smooth out the bumps in your investment journey. When one part of your portfolio isn't doing so well, another part might be thriving. It's like having a financial shock absorber for your money. Now, you might be wondering, does this really make a difference? The answer is a resounding yes. Research shows that diversified portfolios tend to perform better over the long haul compared to those that are concentrated in just one area. During market downturns, diversified portfolios have shown less volatility and better recovery. That means less stress for you and potentially better results for your money. Even Warren Buffett, one of the most successful investors of all time, is a big fan of diversification for most people. He recommends investing in low-cost index funds that track the overall market. These funds automatically give you a slice of hundreds of different companies, which is a great way to diversify when you're just starting out. But here's where it gets really interesting for beginners like you with a small portfolio of $1,000. Experts suggest that you should consider spreading your investments across different types of assets. This might include stocks, bonds, and ETFs, exchange-traded funds. Each of these plays a different role in your financial garden, just like different plants contribute to a healthy ecosystem. Stocks are like the colorful flowers in your garden. They can grow quickly and provide beautiful blooms, high returns, but they're also more sensitive to the weather, market conditions. Bonds, on the other hand, are more like the steady, reliable vegetables. They might not be as exciting, but they provide stability and consistent growth. ETFs are like a pre-made salad mix, a little bit of everything in one. Convenient package. By planting a variety of these financial crops, you're setting yourself up for a potentially more stable and fruitful harvest. When stock prices are falling, your bonds might be holding steady. If the US market is having a tough time, your international investments might be thriving. It's all about balance. This approach to investing is backed by something called modern portfolio theory. It suggests that a diversified portfolio can potentially achieve higher returns for a given level of risk compared to putting all your money in one place. In other words, diversification isn't just about playing it safe. It's about being smart with your money. Remember, diversification doesn't guarantee that you'll never lose money or that you'll always see amazing returns. Investing always comes with some level of risk. But what diversification does is help manage that risk. It's like wearing a seatbelt when you drive. It doesn't prevent accidents, but it can help protect you if one happens. As you continue on your investing journey, keep in mind that diversification isn't a one-time thing. As your portfolio grows and your financial goals change, you'll want to revisit your diversification strategy. It's like tending to your garden. Sometimes the long game, patience pays off. You've probably heard the saying, good things come to those who wait. Well, when it comes to investing, this couldn't be more true. Let's talk about why patience is your secret weapon in the world of finance. Think about it. When you first start investing, it's natural to want to see results right away. You put in your hard-earned $1,000 and you're eager to watch it grow. But here's the thing. The stock market doesn't work like a get-rich-quick scheme. It's more like planting a tree. You don't see results overnight, but give it time and you'll be amazed at how much it can grow. Now, I know what you might be thinking. But what if I need that money soon? Or what if the market crashes? These are valid concerns, but they're exactly why we need to talk about the power of long-term investing. Let's look at some real numbers. Did you know that historically, the S&P 500 has averaged about a 10% annual return over the long term? That means if you invest $1,000 today and leave it alone for decades, it could grow into a pretty impressive sum. But here's the catch. You have to be patient and resist the urge to pull your money out every time the market dips. Warren Buffett, who's basically the Beyoncé of the investing world, puts it this way. The stock market is designed to transfer money from the active to the patient. In other words, Those who are constantly buying and selling often end up worse off than those who buy and hold for the long haul. Now, let's talk about a real-world example that shows the power of patience. Remember the 2008 financial crisis? It was a scary time for investors. The stock market took a nosedive, and many people panicked and sold their investments. But guess what? Those who held on to their investments, even though it was tough, saw their portfolios recover and grow significantly over time. It's like riding out a storm. It might be rough for a while, but clear skies always come eventually. Here's another way to think about it. Investing is like a marathon, not a sprint. You wouldn't expect to run a full marathon on your first day of training, right? It takes time, consistency, and patience to build up your endurance. The same goes for investing. It's about steady progress over years, even decades. Now, I know it can be tempting to check your investment account every day, hoping to see big gains. But that's actually a common mistake that could cost you in the long run. When you focus too much on short-term results, you might make poor decisions based on temporary market fluctuations. Instead, try to adopt a long-term perspective. This doesn't mean you should never check your investments, but maybe limit it to once a month or even once a quarter. Think of it this way. The longer you let your money work for you, the more dramatically it can multiply. It's like a runaway train with your returns earning even more returns. This is the magic of compound interest at work, and it becomes more powerful the longer you stay invested. But what about market volatility? It's true, the stock market can be a roller coaster sometimes. But here's an interesting fact. Investors who adopt a long-term perspective are often better positioned to weather these ups and downs. For example, those who invested in the S&P 500 and held their positions through market downturns have historically seen their investments recover and grow over time. It's like surfing. You have to ride out the waves to get to calmer waters. Remember, investing isn't about getting rich overnight. It's about building wealth over time. When you invest with patience, you're giving your money the opportunity to grow and compound. You're also avoiding the stress and potential mistakes that come with trying to time the market or chase quick gains. So, what does this mean for your $1,000 investment? It means that even if you don't see immediate results, you're still on the right track. Your investment is like a seed that's been planted. With time and patience, it has the potential to grow into something much bigger. Common pitfalls. What not to do with your $1,000. Think you're ready to put that $1,000 to work. Hold on a second. There are some hidden dangers that could turn your investment journey into a costly learning experience. Let's talk about the common pitfalls that catch many beginners off guard. First things first, don't fall into the trap of trying to time the market. It's tempting to think you can predict when stocks will go up or down, but here's the thing. Even the pros struggle with this. Trying to buy low and sell high sounds great in theory, but in practice, it's incredibly difficult to get right consistently. Instead of trying to outsmart the market, focus on consistent, long-term investing. Now, let's talk about the allure of hot stocks. You know, those companies everyone's buzzing about on social media or in the news. It's exciting to think you've found the next big thing, but by the time you hear about a trending stock, chances are you've already missed the boat. Chasing these trends often leads to buying high and selling low, the exact opposite of what you want to do. Instead, stick to a solid investment strategy based on your goals and risk tolerance. Here's something that might surprise you. Before you even start investing, make sure you have an emergency fund in place. I know, it's not as exciting as watching your investments grow. But think about it. If you don't have a financial safety net, you might be forced to sell your investments at the worst possible time. Financial experts recommend having at least 3 to 6 months worth of living expenses saved up. This way, you won't have to dip into your investments when unexpected costs pop up. Let's talk about something that doesn't get enough attention, fees. They might seem small and harmless, but over time, high fees can seriously eat into your returns. It's like a tiny leak in a boat. You might not notice it at first, but eventually, it can sink you. When you're choosing where to invest your $1,000, pay close attention to the fee structures. Look for low-cost index funds or ETFs that won't chip away at your hard-earned gains. Now, here's a big one. Don't panic sell when the market takes a dip. It's human nature to want to protect your money when you see your investment value dropping. But selling when the market is down often means locking in your losses instead of giving your investments a chance to recover. Remember, The stock market has historically gone up over the long term, despite short-term dips and dives. Here's a statistic that might shock you. Only 1% of day traders actually make a profit. That means 99% of people who try to make quick gains by buying and selling stocks frequently end up losing money. It's a sobering reminder that investing is a long-term game, not a get-rich-quick scheme. Another mistake to avoid: investing without really understanding your own financial situation and risk tolerance. Before you put that $1,000 to work, take a good look at your overall financial health. Are you carrying high-interest debt? Do you have a clear picture of your monthly budget? Understanding these basics will help you make smarter investment choices that align with your personal goals and circumstances. Here's an interesting twist. Sometimes, the best investment you can make isn't in stocks at all. Studies have shown that investing in your own education and skill development can often lead to higher returns than traditional stock market investments. So while you're planning how to invest that $1,000, don't forget to consider how some of that money could be used to boost your own earning potential through courses, certifications, or other forms of personal development. Now, let's talk about putting all your eggs in one basket. It's tempting to go all in on a single stock or investment type that you're excited about. But diversification is key to managing risk. Spreading your $1,000 across different types of investments can help protect you from significant losses in any one area. Consider a mix of stocks, bonds, and maybe even a small portion in something like real estate investment trusts, REITs, to create a more balanced portfolio. Lastly, avoid the temptation to invest in individual stocks without doing your homework. It's easy to get caught up in the excitement of owning shares in a company you like, but remember, about 90% of people lose money when trying to pick individual stocks. For beginners, it's often safer and smarter to consider index funds or ETFs. These give you exposure to a wide range of companies, spreading out your risk and making it easier to benefit from overall market growth. Growing beyond $1,000. Keep the momentum going. All right, let's talk about taking your investment journey to the next level. You've made a smart move by investing your first $1,000. That's a big step. But here's where things get really exciting. What if I told you that adding just one cup of coffee's worth of money each week could dramatically change your financial future? Let's explore how small, consistent actions can lead to big results. Think about it. Your initial $1,000 investment is like planting a seed. Now it's time to nurture that seed and watch it grow into a flourishing money tree. One of the most powerful ways to do this is by making regular contributions to your investment account. Even small amounts can make a huge difference over time. Here's a mind-blowing example. If you can add just $50 a month to your initial $1,000 investment, after 30 years at a 7% return, you'd have over $62,000. That's the power of consistency and compound interest working together. It's like giving your money superpowers. But don't stop there. Another smart strategy is to invest any windfalls you receive. Think about those unexpected chunks of money that come your way: tax refunds, work bonuses, or birthday gifts from your grandma. Instead of splurging on something you'll forget about in a month, why not put that money to work for your future? Now, I know what you might be thinking, but I don't have any extra money to invest. Trust me, I've been there. That's why it's important to look for ways to cut expenses and redirect that money to your investments. It doesn't have to be painful. Small changes can add up fast. Maybe you can make coffee at home instead of buying it out, or have a movie night instead of going to the theater. Every dollar you save and invest now has the potential to grow over time. It's like sending your future self a thank you gift. Remember, building wealth isn't about making one big, dramatic move. It's about making smart choices consistently over time. Each time you add to your investments, you're giving your money more time to grow and compound. It's like rolling a snowball down a hill. The longer it rolls, the bigger it gets. But here's the thing. Growing your wealth isn't just about the numbers in your bank account. It's also about growing yourself. One of the best investments you can make is in your own skills and knowledge. Think about it. If you spend $1,000 on a course that increases your income from $50,000 to $60,000, that's a huge return on investment. Investing in yourself can lead to better job opportunities, higher earning potential, and more money to invest. It's a virtuous cycle. The more you learn and earn, the more you can invest, and the more your investments can grow. Another key to keeping your investment momentum going is to set clear financial goals. Are you saving for a house? Planning for retirement? Wanting to start your own business? Having a clear goal can help you stay motivated and make smart investment decisions. For example, if you're saving for a house in a few years, you might want to avoid high-risk investments and focus on more stable options. On the other hand, if you're planning for retirement decades away, you might be comfortable taking on more risk for potentially higher returns. One of the best ways to stay consistent with your investing is to make it automatic. Set up automatic contributions from your paycheck to your investment account. This way, you're investing regularly without even having to think about it. It's like putting your wealth building on autopilot. As you continue on your investment journey, don't forget about the power of diversification. Remember, it's not just about how much you invest, but also how you invest it. Spreading your money across different types of investments can help manage risk and potentially improve your returns. For beginners, investing in diversified index funds can be a great strategy. These funds give you exposure to a wide range of companies, spreading out your risk and making it easier to benefit from overall market growth. Another option to consider as you grow your investments is dividend-paying stocks. These can provide a steady income stream, which you can reinvest to purchase more shares. This is another way to compound your returns over time. Building a network and investing in personal development can also indirectly boost your wealth. The connections you make and the skills you develop can lead to better job opportunities and increased income, which you can then invest to grow your wealth even further. The investor mindset, your most valuable asset. Let's talk about something that's often overlooked when it comes to investing, your mindset. You might think that successful investing is all about picking the right stocks or timing the market perfectly. But here's the thing. What if I told you that how you think about money and investing is just as important as the money itself? Developing an investor mindset is like building a strong foundation for a house. It's not flashy, but it's absolutely essential. When you have the right mindset, you're better equipped to make smart decisions and stick to your financial goals, even when things get tough. So, what does an investor mindset look like? Well, it's about thinking long-term and focusing on your goals, not getting caught up in the day-to-day market noise. It's like planting a tree. You don't dig it up every day to check on the roots. You trust the process and give it time to grow. One key aspect of this mindset is how you view market dips. Instead of panicking and selling when prices drop, you see these moments as opportunities to buy more at a discount. It's like shopping during a sale. You get more bang for your buck. But having an investor mindset isn't just about how you react to market changes. It's also about continuously educating yourself about personal finance and investing. Think of it as sharpening your tools. The more you know, the better equipped you are to make informed decisions. Self-awareness plays a huge role in successful investing. Understanding your own financial habits and patterns can help you identify areas that need attention before you make investment decisions. It's like knowing your strengths and weaknesses in any other area of life. This knowledge helps you improve and grow. Here's something interesting to consider. Experts suggest that the difference between successful and unsuccessful investors often comes down to what they call the performance gap. This gap is the distance between where you are now and where you want to be financially. Closing this gap isn't just about the money you invest. It's about the focused effort and mindset you bring to the table. Patience, discipline, and consistency are all key ingredients in the investor mindset recipe. It's about sticking to your investment strategy, even when it feels tough. Remember, every successful investor started somewhere, often with small amounts like your $1,000. They didn't become experts overnight, but they stayed committed to their goals and kept learning along the way. Speaking of learning, did you know that some of the most successful investors prioritize continuous education? Take Charlie Munger, for example. He emphasizes the importance of becoming a lifelong learner. This doesn't mean you need to become a financial expert, but staying curious and open to new information can really pay off in the long run. A healthy attitude towards money is another crucial part of the investor mindset. It's about understanding that investing isn't just about making quick profits. Instead, it's about building wealth over time through patience and consistent contributions. Think of it like tending a garden. You plant the seeds, water them regularly, and watch them grow over time. One of the trickiest parts of investing is managing your emotions, especially during market volatility. It's natural to feel nervous when you see your investments dip, but investors with a strong mindset are better equipped to stay calm and make rational choices. They understand that market fluctuations are normal and part of the process. Developing this kind of mindset takes time and practice. It's about training yourself to view investing as a long-term journey rather than a short-term gamble. When you do this, you're more likely to stick with your investment plan and see better results over time. Remember, your mindset isn't just about how you think. It can have a real impact on your financial success. Investors who maintain a positive attitude towards investing often make better decisions. They're more likely to see market dips as opportunities rather than disasters, which can lead to smarter choices in the long run. Cultivating an investor mindset also means setting clear financial goals and working consistently towards them. It's like planning a road trip. You need to know where you're going and how you're going to get there. Having these goals can help you stay motivated, especially when the market gets bumpy. Taking action, your next steps. You've got the knowledge, but here's the thing. Knowledge without action is just wasted potential. We've covered a lot of ground in this video, from understanding investing basics to avoiding common pitfalls. But all this information is useless if you don't take action. So let's talk about turning that $1,000 and your newfound knowledge into real results. Your first step is to choose a brokerage and open an account. Remember, this isn't as complicated as it might sound. Many people put off investing because they think opening an account is a hassle, but it's actually pretty straightforward. You can do it in just a few minutes using your phone or computer. Popular brokerages for beginners include Fidelity, Charles Schwab, and Vanguard. Each has its own strengths. Fidelity offers a wide range of options with no minimum balance for most accounts. Charles Schwab provides commission-free trading and a user-friendly mobile app, and Vanguard is known for its low-cost index funds and ETFs. When you're setting up your account, be honest about your financial goals and risk tolerance. This helps the brokerage guide you towards suitable investments. And don't worry, many brokerages allow you to start investing with as little as $1. Some even offer virtual money for practice investing before you use real cash. This can be a great way to get comfortable with the process without any risk. Next, it's time to decide on your investment strategy. Will you go with index funds, ETFs, or a mix of both? Think about what makes the most sense for your situation and goals. Remember, there's no one-size-fits-all approach to investing. What matters is choosing a strategy that you understand and feel comfortable with. One smart move is to set up automatic transfers to your investment account. Even if it's just $25 a week, consistency is key. This approach, known as dollar-cost averaging, can help reduce the emotional stress of investing and allow you to gradually build your portfolio over time. It's especially helpful if you're unsure about market conditions or feeling nervous about investing a lump sum all at once. Now, here's something that's often overlooked but incredibly important: investing in yourself. Spending some of that $1,000 on education or skill development can significantly increase your earning potential. For example, investing in a certification course could lead to a higher-paying job, providing a return on investment that far exceeds typical market returns. This kind of investment in yourself can open up new opportunities and boost your overall financial situation. As you start your investing journey, it's crucial to have a clear plan. Here's a simple checklist to keep you on track. 1. Assess your current financial situation and set clear goals. What do you want to achieve with your investments? Are you saving for retirement, a down payment on a house, or something else? 2. Choose a brokerage that fits your needs. Consider factors like fees, investment options, and user interface. 3. Decide on an investment strategy. Will you focus on index funds, ETFs, or a mix of different assets? 4. Set up automatic contributions to your investment account. This helps you stay consistent and takes advantage of dollar-cost averaging. 5. Continuously educate yourself about investing. The more you understand, the more confident you'll feel making financial decisions. Remember, many successful investors started with small amounts, just like you're doing with your $1,000. This is often highlighted as a manageable entry point into investing, allowing you to gradually build your portfolio over time. Don't underestimate the power of starting small and consistently adding to your investments. Another important aspect to consider is diversification. Investing in a diversified portfolio can help mitigate risks. For example, You could allocate your $1,000 across different asset classes, such as stocks, bonds, and real estate. This provides a buffer against market volatility and helps protect your investment. As you embark on this journey, be patient and keep learning. Investing isn't about getting rich overnight. It's about building wealth over time. Stay curious, ask questions, and don't be afraid to seek advice from reputable sources. The more you understand about investing, the more confident you'll feel making your financial decisions. Now, let's talk about a nifty little trick that can help you visualize your investment's growth. Have you ever wondered how long it might take for your money to double? Well, there's a simple way to estimate that, and it's called the Rule of 72. Here's the thing. Many of us struggle to picture how our investments will grow over time. It's not always easy to wrap our heads around compound interest and long-term returns. But understanding this growth is super important. It helps us set realistic expectations and stay motivated on our investing journey. So, let's dive into this Rule of 72. It's a quick and easy formula that gives you a ballpark figure for how long it'll take your investment to double. And the best part, you don't need to be a math whiz to use it. Here's how it works. You just divide 72 by your expected annual return rate. That's it. The result gives you an estimate of how many years it'll take for your money to double. Let's break it down with an example. Say you're expecting a 7% annual return on your investment. You'd divide 72 by 7, which gives you about 10.3 years. So in roughly 10 years, your initial investment would double. Pretty cool, right? The beauty of this rule is that it works for any rate. If you're feeling optimistic and expect a 10% return, your money would double in about 7 years, 72 divided by 10. On the flip side, if you're being more conservative with a 5% expected return, it would take about 14 years for your money to double. Now, keep in mind that this rule isn't exact. It's more of a quick estimation tool, but it's incredibly useful for getting a general idea of your investment's growth potential. Brian Ford, the head of financial wellness at Truist, is a big fan of the Rule of 72. He says, "It's basically the length of time it takes for an investment to double, and it's a pretty simple calculation." And he's right. It's a straightforward way to wrap your head around the power of compound interest. This rule is especially helpful for those of us who are just starting out on our investing journey. When you're a beginner, it can be tough to visualize how your investments will grow over time. The Rule of 72 gives you a concrete way to picture that growth, which can be super motivating. Think about it. If you invest $1,000 today and expect a 7% annual return, you can estimate that in about 10 years, you'll have $2,000. In 20 years, that could become $4,000, and in 30 years, potentially $8,000. Of course, this is a simplified example, but it shows you how powerful compound interest can be over time. The Rule of 72 has been a popular tool among investors for decades. It stood the test of time because it's so simple and effective. It's one of those financial tricks that can really help you get your head in the game when it comes to investing. But here's an important point to remember. While the Rule of 72 is a great guideline, it's not set in stone. The real world of investing is a bit more complicated. Things like market volatility and economic conditions can affect how your investments actually perform. So, use the Rule of 72 as a starting point. It's a fantastic way to get a quick estimate and to understand the potential of your investments. But don't forget to consider other factors when you're making your investment decisions. The Rule of 72 can also help you compare different investment options. For example, if you're trying to decide between two investments with different expected returns, you can use this rule to see how long it would take your money to double in each scenario. This can give you a clearer picture of which option might be better for your goals. Remember, investing is all about the long game. The Rule of 72 helps drive home that point by showing you how time and compound interest work together to grow your wealth. It's a reminder that patience and consistency can really pay off in the investing world. So, next time you're looking at your investments or considering a new one, give the Rule of 72 a try. It's a simple but powerful tool that can help you make smarter decisions with your money. And who knows, it might just give you that extra boost of confidence to take the next step in your investing journey. Risk management, protecting your $1,000 investment. Now, let's talk about something that might surprise you. What if I told you that one of the smartest investing moves isn't about making money at all? It's about protecting what you've built. That's right, we're diving into risk management, and it could make or break your financial future. Think about it this way. You've worked hard to save that $1,000, and now you're ready to put it to work. But here's the thing. If you're not careful, you could end up losing a big chunk of it. That's where risk management comes in. It's like a safety net for your money, helping you avoid costly mistakes and keep your investment journey on track. So, how do we go about managing risk? Well, it starts with understanding yourself. Seriously, everyone has a different comfort level when it comes to financial ups and downs. Some people can handle big swings in their investment value without breaking a sweat, while others might lose sleep over a small dip. That's called your risk tolerance, and it's super important to figure out where you stand. Once you know your risk tolerance, you can make smarter choices about where to put your money. If you're the type who gets nervous easily, you might want to stick with more stable investments. On the other hand, if you're comfortable with a bit more excitement, you could explore options that might have bigger potential returns, but also bigger potential losses. Remember how we talked about not putting all your eggs in one basket? That's a key part of risk management too. By spreading your $1,000 across different types of investments, you're less likely to lose everything if one investment doesn't do well. It's like having a backup plan for your backup plan. Another smart move is to only invest money you won't need anytime soon. Your $1,000 should be extra cash that you can afford to leave alone for a while. Why? Because investments can go up and down in the short term, but historically, they tend to grow over longer periods. If you might need that money next month for rent or groceries, it's probably better off in a savings account. Speaking of time, let's talk about your investment horizon. That's a fancy way of saying how long you plan to keep your money invested. If you're young and saving for retirement, you've got decades ahead of you. That means you can probably take on more risk because you have time to recover from any downturns. But if you're planning to use the money in a few years for a down payment on a house, you might want to play it safer. Here's something a lot of new investors forget about: rebalancing. Over time, some of your investments might grow faster than others, which can throw off your original mix. Rebalancing means adjusting your investments periodically to get back to your target mix. It's like giving your portfolio a tune-up to keep it running smoothly. Now, you might be wondering if all this risk management stuff really makes a difference. Well, the numbers don't lie. Studies have shown that effective risk management can significantly impact your long-term investment returns. A well-diversified portfolio can help smooth out the bumps in the road, potentially improving your overall returns compared to putting all your money in one place. But here's the real kicker. Risk management isn't just about numbers. It's about peace of mind. When you know you've taken steps to protect your investment, you're less likely to make rash decisions based on fear or greed. And that, my friend, is one of the biggest keys to successful investing. Let's get practical for a moment. How can you start managing risk with your $1,000 investment? First, consider setting aside a portion of it, say $200, in a high-yield savings account. This can serve as a mini emergency fund, giving you a cushion if unexpected expenses pop up. Next, think about splitting the remaining $800 between a low-cost index fund that tracks the broad market and a bond fund. The exact split depends on your risk tolerance, but a common starting point for young investors might be 80% stocks via the index fund and 20% bonds. This gives you exposure to growth potential while also providing some stability. As you get more comfortable with investing, you can explore other ways to manage risk. For example, you might look into target date funds, which automatically adjust their risk level as you get closer to your goal date. Or you could consider dollar cost averaging, where you invest a fixed amount regularly instead of all at once. Remember, the goal of risk management isn't to eliminate all risk. That's impossible in investing. Instead, it's about finding the right balance between risk and potential reward for your personal situation. It's about making sure you're not taking on more risk than you can handle, both financially and emotionally. Tracking your progress, staying motivated on your investment journey. Now, let's talk about something that might surprise you. Have you ever wondered if watching your investments grow could be as exciting as binge watching your favorite TV show? While it might not have the same drama as a season finale, tracking your investment progress can be pretty thrilling in its own right. Here's the thing. Many people fall into the trap of checking their investments too often. It's like constantly peeking at a cake in the oven. It won't make it bake any faster. and you might even be tempted to take it out too soon. Checking your portfolio daily can lead to unnecessary stress and might even push you to make poor decisions based on short-term market fluctuations. But on the flip side, completely ignoring your investments isn't the answer either. You don't want to miss out on important changes or opportunities. So, what's the sweet spot? Financial experts suggest a balanced approach. 4 long-term investments. Checking in once a month or even once a quarter is usually enough. This frequency allows you to keep an eye on things without getting caught up in the day-to-day roller coaster of the market. Think about it this way. Your investments are like a garden. You plant the seeds, your initial investment, water them regularly, add more money over time, and then let nature do its thing. You don't dig up the plants every day to check on their roots, right? Instead, you check in periodically to make sure everything's growing as it should. So, how can you keep track of your investment garden without becoming obsessed? Most brokerage firms offer apps or websites that make it easy to see your portfolio's overall performance. These tools often provide visual representations of your asset allocation and other helpful metrics. It's like having a gardener's almanac at your fingertips. Speaking of asset allocation, that's something you'll want to pay attention to during your check-ins. Is your mix of investments still in line with your goals and risk tolerance? As you grow and change, your financial needs might shift too. Maybe you started out with a more aggressive strategy, but now you're thinking about buying a house in the next few years. Your investment mix might need to adjust accordingly. Here's a pro tip. When you're looking at your investments, try to focus on the big picture rather than getting caught up in short-term changes. It's like watching a plant grow. You won't see much difference day to day, but over weeks and months, the progress becomes clear. And hey, don't forget to celebrate your milestones. Did your portfolio reach $1,500? $2,000? Take a moment to appreciate how far you've come. It's these little victories that can help keep you motivated on your investment journey. Now you might be wondering, does it really matter how often I check my investments? Well, research suggests it does. Studies have shown that investors who check their portfolios less frequently tend to have better long-term returns compared to those who check them daily. It's not just about avoiding stress. It's about making better investment decisions. Think about it like this. If you're constantly watching your investments, you might be tempted to react to every little market movement. But the stock market is naturally volatile in the short term. By taking a step back and looking at the bigger picture, you're more likely to stick to your long-term strategy and avoid making emotional decisions based on temporary market swings. Remember, investing is a marathon, not a sprint. It's about building wealth over time, not getting rich overnight. By checking in regularly but not obsessively, you're giving yourself the best chance of staying on track with your financial goals. So, what's the takeaway here? Set up a schedule for checking your investments that works for you. Maybe it's the first day of each month or every quarter when you get your account statement. Use the tools your brokerage provides to get a clear picture of your overall performance and asset allocation. And most importantly, keep your focus on your long-term goals. By finding this balance, you can stay informed about your investments without letting them take over your life. You'll be able to make informed decisions when needed, while also giving your investments the time they need to grow and compound. Let's talk about the power of starting your investment journey today. As Warren Buffett wisely said, the best time to plant a tree was 20 years ago. The second best time is now. This applies perfectly to investing. Your $1,000 isn't just money sitting in an account. It's the seed of your financial future, ready to grow into something amazing. Here's the thing. Investing is a journey, not a sprint. It's about taking that first step, no matter how small, and then staying consistent. Every dollar you invest is like planting another seed in your financial garden. And remember, as Brian Ford from Truist points out, time in the market beats timing the market. This means it's more important to start investing and stay invested than to try and predict the perfect moment to jump in. So think about it. What's your next move? Are you ready to plant your financial seeds and watch them